Welcome back to the halftime report. Shares of J.P. Morgan falling 13% in the last 3 months. Jefferies throwing in the towel today. They downgraded the stock. It's our call of the day. Did it to a hold. We made it the call of the day because you don't see J.P. Morgan get downgraded all that often. What do we think of it? They're talking late cycle. Obviously, what rates have done.
Yeah.
How are you going to be a big believer in these?
Well,
right on the cusp of earnings season.
110 price target. Best in breed name. I believe that. I think when you're looking at financials and understanding that you're seeing right now rates go down and understanding the environment maybe is not favorable for financial institutions, I think that takes you right to J.P. Morgan. I think that's exactly where you want to be. Why? Because I think the C&I loan growth that you're going to see is going to be somewhere around 5%. They have a strong presence there. I think overall loan growth is going to look strong at around 2.5%. So I still think J.P. Morgan has the strong footprint with the consumer.
Okay.
And I think that's where the diversification of J.P. Morgan's ownership in your portfolio for a financial institution comes into play and benefits you.
Steph, is the best of the so-called worst, as in the financials, good enough? Good enough reason to own. Right, J.P. Morgan may be deemed the best, but if the group isn't going to do anything, does it really matter?
No, because I think the big five kind of trade the same. And they vary a little bit. I mean, based on what you think the yield curve is going to do, what rates are going to do, so and what kind of trading environment is going to do. So they'll all kind of trade a little bit differently, but for the most part, they do kind of trade together. J.P. Morgan is a risk-off bank, so if you kind of don't want to own the riskier, higher beta names, you'll own J.P. Morgan and kind of just sit with it, so you have your exposure kind of thing. It's a great company. We know it has a fortress balance sheet. Blah blah blah. Trading at 10 times. Okay. But no, if you don't want to own banks, you don't own banks.
Well, that's what I'm saying, right?
Yeah,
J.P. Morgan, in many respects, deserves the benefit of the doubt, right?
Yeah.
Fortress balance sheet, Jamie Dimon at the helm, all the reasons in the world to say, I love this stock, it's $100. Josh Brown, I think, said under 100 it was a gift, right? He bought it recently, thought it was going to at least 110. But is that enough?
Well, I mean, that may turn out to be all you get. I mean, this feels much more like a sector call than a specific to J.P. Morgan.
Well,
Yes,
they do talk about a lot of the other banks, too. But we focus on this because you just don't see JPM downgraded all that often.
And if you're going to be in this sector, this is the name that you want to own. This is the creme de la creme.
Should you be in the sector or not?
I think, yes, you should, but I think your expectations should be muted. This is not going to be like technology where you could be up 35, 40% in just a few months. And the reason is you're not going to see those sorts of returns. Well, no kidding is you've got a very flat yield curve. You've got credit card reserves that have been rising over time. You've got housing that isn't quite working, so you don't have mortgage lending. You've got disintermediation from fintech. That's the point, though.
That is
but without
all known,
any of that,
it's in the price
without
right
any
now.
of that, you're not going to get more than a 10% return from the sector.
In the financials?
Yes, we're in the financials.
You have to be.
You have to be.
Why do you have to be?
Because 15% of the S&P, and no one's smart enough to know not to be completely in a sector.
So at 10.3 times, the sector trades at 10.3 times. 10-year average is 12.5 times. Yes, you have rate concerns. Yes, you have everybody thinking the cycle's over. If you believe that the cycle continues and you're not in financials, when their total yield right now, which is 7%, you're not seeing that in other sectors. In addition, there's this whole notion of return to value over growth because value has been cheap, and you're seeing it so far this year. And this is a huge component of the value ETFs. ETF investors haven't left. They're going to come back. They're going to buy the value ETF, and financials are a large constituent component of it.